All right.
So can you tell me a little bit about what you've studied in the past, how long you've been trading, and what kind of style you've been trading?
All right. I started trading about for 2 years plus, and I studied a lot of like SMC concepts.
Okay.
Yep.
For how long?
And for for about 6 months, I guess,
Okay.
regarding SMC, but I find it quite confusing.
Right.
Yep. And
And
recently, I gonna start studying about Malaysian support resistance and trend lines.
okay.
Yep.
And
So I'm trying to incorporate those concepts. Yep.
so with the SMC, I'm guessing you were just following like the basic stuff, like the stop
Those
break market.
breakout structure and yep.
Okay. And then I'm guessing when you would do your analysis, it would be starting from monthly, weekly, or what time frames would you be starting on?
I'll start from the weekly to daily and 4H.
And then as far as the Malaysian SNR, which concepts have you learned from that?
Um, I've watched a few of your free courses on that.
Okay.
Yep.
You know,
And I've been drawing like those levels, but I don't know which one you would like respect. Yeah.
right.
Yep.
And are you profitable trading or are you not profitable?
Not profitable.
Not profitable. Okay. And you've only been trading 6 months, right?
Yes, with a demo account.
Okay. So yeah, the journey of a trader is going to be a little bit different for everyone. You started 6 months ago, so it's not that long, which is good and bad. It's good because you can get the proper education right now versus spending years trying to figure out what the proper education is. Um, with SMC, so smart money concepts, it's going to take around 1 to 2 years. And then the thing that that most SMC traders fail on is the low win rate, high reward, right? Because with SMC, once you find out that the win rate is going to be around 20 to 30%, but your risk reward will probably be 1 to 5, 1 to 10. Not a lot of people can withstand the low win rate, you know. Because of this, they may have a profitable strategy, but because they didn't give it enough trades or enough time, they might not see the success, so they might switch to something else. You know, they might switch to Wyckoff, they might switch to Fibonacci style trading, they might switch to indicators, they might switch to Malaysian SNR. So the number one thing to do is to stick with the strategy, right? You have to stick with one strategy and master the strategy. Once you master it, then you can tweak it and make it better over time. But typically with SMC, it's going to be around 20, 30%, 1 to 5, 1 to 10 RR. And you would do that over months and many trades to get the statistical significance of the strategy, right? So the reason this fails is obviously because of the low win rate. But it's still a winning concept. It still works. As far as Malaysian SNR, which I had traded for a while, it's a great concept because it gives you a better insight of market direction, right? What side of the market to be on. But from there, from Malaysian SNR, you have SNR storyline and multiple time frames. And some will use trend line. But there's also a flaw in this system as well. The flaw is it's going to take you a lot longer to master. So it may take 1 to 3 years to master. And the reason is because of this part of the storyline, right? So the storyline is going to be very confusing because you could have monthly to monthly, weekly to weekly, daily to daily. But then, for example, if we look at the line chart here, you have monthly breakout, which should signal the bullish price action going higher, right? And then the same thing here, you have a bearish breakout, which should signal the market going lower on a pullback, but instead it goes higher. So this is why I don't practice SNR. It's a good way to adapt some of the elements from SNR, but not all of them. Because what you could say is there is a weekly above somewhere in here for the price to reject, which would change the storyline to bearish. But it's just too complicated because then you always have to keep in mind every single time frame and every single time frame's storyline until it completes. So it's not the best strategy, but it's still a very, very good one, and you can make a lot of money from it once you master it. But you will get really confused in the storyline, let alone multiple time frame. So multiple time frame can be one of the most confusing concepts to learn. So for me, I make my strategy very, very simple, and I wouldn't even say it's my strategy. It's adapted from many people. I've been trading since I was 16 years old. I'm 33 now, so it's about 13 years. And I've traded most of the styles. I've traded Wyckoff, SMC, supply and demand, traded options, traded futures, traded crypto, Forex, obviously. I've done the Malaysian SNR. I've done pretty much almost every style, and I've spent a lot of time on each style to come across what I think is significant and has a lot easier to understand. It's a lot easier to read, and the best part is it's mechanical. So everything I do is it has rules. It's rule based. So there's no questioning of if this is a level or if this is not a level, if this is a good entry, if this is not a good entry. Everything is solved. So for me, OHLC, time frame, and trend line. Are you familiar with OHLC?
Yes.
Can you tell me a little bit?
High, low, close of the candle. Yeah.
Yeah. So open, high, low, close. So today, we'll be breaking down each one of these into subdivisions so that we can understand each part, because we keep it simple by saying there's 3 parts, right? But then there's an understanding of the open, the high, the low, and the close. And then there's an understanding of the multiple time frame, which is short MTF. And then there's an understanding of trend line. None of this is subjective. Okay, there's no subjectiveness in the system. It's all objective. So we'll break each one down. So as far as open, high, low, close, we have to actually go over what that is. It's not just a candlestick. It's a language. Okay, so here I'm drawing a bearish candlestick. But don't get confused and think that because the candle is red, it means it's bearish. That's false. Okay, this is a false statement. What we need to pay attention to is the open, the close, a high, and the low. Okay, so here we have just the basic candlestick anatomy of just a bearish candle, even though that doesn't mean that it's bearish, it's just a bearish candle. That doesn't mean the direction is going to be down on the next candle, and it doesn't mean that the direction is going up. It's just a simple example, right? So what are the most significant parts of this particular candle? The most significant parts are these two right here. Of this singular candle, the closing price. The closing price is going to tell us everything we need to know. And the low is going to tell us, because sometimes there won't be a low, so the close is more important. It takes priority over the low. But this low is also going to tell us where we reject, right? As long as we close above a certain key level, then we know that we have our closing price to tell us what's going to happen on the next candle. Okay, so we must understand the closing price at all times. We need to pay attention to where price closes. That will give us the language to follow. So now we're going to talk about a key level. So what makes a key level? Well, let's first look over at this example. In this candle, we can view the perspective of the candle as a conference, right? That there are many traders in the market, and let's just say this is a H4 candle. We can say that there's many people coming to the conference during the H4 open, and they know that the meeting closes in 4 hours, right? The conference is over in 4 hours. So we have a discussion about the price during this 4 hours, and the close is the settlement, right? It's the settlement of the price of where they all agreed that this is the price for the H4. Okay, so that's the significance of this, and this is how we have to view it. The thing we don't want to do is we don't want to view the chart as a pattern. We don't want to look at patterns. We want to understand this. If we can understand this, then we can understand the language of this chart, and we're not looking at, oh, this is an order block, or this is supply. We're not looking at it like that. Okay, we're paying attention to the opens and closes. So yes, we have the open and the close. This will be the significant area. So how do we get a key level to figure out what is significant? So let's use this example here, the same one, but I'm going to remove the So let's say we have a drop after this. And we can have a wick and another wick. And then the next candle, since we close here, right? This is the closing price. We do something like this. For me, this is a bullish indication if the price closes above the previous open. So this is how we get our key level. And it's not because it's engulfing. That's not what I'm looking at. What I'm looking at is the closing price. See how we open here and then we drop and then we close. This was the market's decision to close here. But then on the next candle, the market opens here and closes and surpasses the open. That's what generates your key level, not the fact that it's engulfing or that it's an order block or whatever you want to call it.
Does it have to close above the high of the previous candle?
It doesn't need to close above the high, it just needs to close above the open. It could close like this. And then that is still a bullish signal for the price to go higher. Let's look at another example. So let's say we have some sort of candlesticks that look like this, and it's not about the candle's pattern, right? It's about the open and the close. So here is the previous candle's open, which was surpassed by this candle's close, right? Because we closed here. So in this case, we have two key levels. We have a key level here and here. Why is this a key level? Because in the event that we had some sort of bearish price action in the past, let's say something like this. From here, we broke this open, right? So this at one point was a key level. The key level doesn't matter if it's been fresh or unfresh, if it's closed above or below, it doesn't matter. We can still use that in future reference. And I'll show you some examples when we get on these charts over here. But as long as we can identify what a key level is, you'll be fine. As long as you understand that the previous candle's open was surpassed, it was the level that originated the move downwards to start the close. So we can see here, we broke the previous open. So this becomes the key level. This is what we're always paying attention to for one is direction and two is breakout. So for direction, for example, if we have something like this, this surpasses the previous candle's open. This candle, right?
Yep.
So this is a sign of the continuation higher. While most people are trying to sell in this area, we already know ahead of time that the market has actually made the decision to go higher. Now, if it failed to do that and rejected this level, then we know that the market made a decision to actually go lower. So let's look at some chart examples. So a key level would be something such as, let's use H4 for more examples. Why is this still a key level? Like I said, we can use it in the future reference. But here we have an open that was surpassed by the close. So this becomes the key level right here. This candle breaks that open, but then comes back up and closes above it. It's still a key level. This is our main area of focus because it's a key level. It was an open that had surpassed, or a close that had surpassed a previous open. So we can still use that in the future reference. Another example would be this, and where we got the drop. It's because this close surpassed the previous open. It was broken from this level. So yes, we can use that in the future, even though the price had moved through it and back down through it. We can use this in a future reference to catch the drop. This candle was breaking this open level, right? This is the previous open, and this candle surpasses it. And where did the move start? It started from here. We see that this open was succeeded by this candle, but then was broken by this candle, right? We closed above it, signaling the continuation to the upside. Where did the move start? It started here. And we get our continuation. This open was succeeded by this close. So this becomes a key level. And prior to that, we had this succeeded by this, right? This is an open that was broken by a close. And this is how we catch the drop here. Is this making sense so far?
Yes.
Here, we have a sign of the continuation. This open was succeeded by this close. The move started from here. And we could drag that out to the future as well. This open was succeeded by this close. So we know that this was the continuation. Does this work on the daily? Yes, it does. Does this work on the weekly? Yes, it does. Same thing. And when we can't surpass the level, we'll likely get the reversal. Do the next area, but we have this area as well. This succeeded this, and then it was broken. We have this level, which broke downwards, surpassing a previous level. And then it was broken upwards. So this is still our key level that we can use in the future as reference. Now this may be slightly off because of the broker, but this one hit based on whatever broker you're using. So we're just following the open and closes of the candles. Now you can't solve everything just using open, high, low, close. There's obviously multiple time frame and other confluences that we have to go over throughout the session, but we need to make sure that we understand the entire concept. Otherwise you can get lost in the market's language. How about this drop? We have a open that was surpassed by a from this origin level, right? And this is how we get the big drop. What about on weekly? The same thing on weekly is showing you the same sign on the daily. This drop. We can see that this open closed down here, breaking several levels, right? And the price reacted from here. But like I said, we can extend this out to the future. And you get the same reaction. And you get the big move here. What about on daily? We get the same observation. Same level. So we can see our open and close level here. One here as well. What about this one? So we also have to understand that not everything can be solved in one time frame. A lot can, but not everything. And it doesn't matter how many times the level was hit. If it cannot surpass, it's still a level, including the big drop from last week. What about the rally? Well, this is an open close level as well. Is this making sense?
Yep.
Okay. So now that we understand OHLC, we need to expand on the topic. Which will be how to get the bias. We need to understand the monthly bias, the weekly bias, the daily bias, the bias, one bias, and that's it. Those are the only time frames I use. So a question that you must ask yourself is, when do I check the bias, right? So if we want to get the monthly bias, we need to wait for the monthly close. If we want to get the weekly bias, we need to wait for the weekly close. And if we want to get the daily bias, we obviously have to wait for the daily close. And the same thing goes for H4, and the same thing goes for H1. So with that being said, we need to understand that the previous day will tell us what happens on the next day. And the same thing goes for the week and for the month. So daily will tell me what happens on the next day. Weekly will tell me what happens on the next week. Monthly will tell me what happens on the next month. H4 will tell me what happens on the next H4. And H1 will tell me what happens on the next H1. But now the question is, how does it tell you, right? So let's take a look at over here. So we see that this previous open was succeeded by this close. So this becomes a key level. Now this daily candle rejected and closed above our key level. It didn't break it. That gives me the next day's bias, right? This is a bullish statement, even though it's a bearish candle. It tells me what I need to do for the next day. Oh, I need to be on buying tomorrow. Does that make sense?
Yep.
The same thing here. Here we have a breakout of our open close level here, starting from this level. The price rejected this level, telling me what my bias is on the next day. It should be on buying. This is still a level here. We get a rejection of the level, so it tells me the next day I should be on buying until I reach my next key level. Now the bias is changing. It tells me after this rejection, the next day I should focus on selling. The same thing here. the daily switched to being bearish. So the next day, I know I should be on selling. Use this chart. Here we get a closure above our key level. It's telling me the next day I should be on buying. The same thing here. Same thing here. Same thing here. Because we reject it. I should be on selling the next day. We reject it. I should be on selling the next day. We reject. I should be on selling the next day. We reject here. I should be on selling the next day. So I'm getting my bias. Does that make sense so far?
Yes.
Now, when that doesn't work out, it's because, like I said before, not everything can be solved on a single time frame. We have to think, how can the H4 continue, or the daily continue if the H4 can't? How can the weekly continue if the daily can't continue, right? So if we don't have a sign of continuation, then the trade is not going to go in the direction that we want it to. Right? And what do we mean by sign of continuation? It's like I said before, it needs to surpass the level. This is your real breakout. Right? This is the signal that the price should continue higher. Now, it doesn't have to continue exactly like this. We can have a drop, but we have to understand that that drop right? Because we had a breakout. This is the indication of continuation. But how do we understand when the pullback is no longer a pullback? Is if the drop succeeds the level that caused the breakout. Right? So if this level right here is surpassed and closed, then there's no more pullback. Now we have a change in direction. In order for us to validate the pullback as a pullback, it needs to reject this level and close above. Have you seen anything like this before?
No, it's my first time.
Okay. So yeah, we understand how to tell the bias. For example, let's look over here. I like to use this as an example. Okay, so this price came from a trend line, which we'll cover later, but we understand that the price was going to go higher at this level. But then we have an open close level here that it failed to surpass. Right? We have a bullish candle, which is actually signaling for another drop because it failed, right? It could not surpass this. So there is no sign of continuation here. So what do we get on the next candle's bias? We get the drop for the next hour. But then we have this open close level that was rejected and closed above. So we know the bias on the following candle is going to be bullish. But then here we have a rejection of the same level, signaling that the next candle should have a drop. But this candle's bullish, so what happened? Well, we did have the drop right here. This whole candle was the drop. But what did it drop to? This prior open and close candle, right? Because the previous open was succeeded by the close. So yes, at this point, we knew that this candle could possibly go bullish. Doesn't mean enter there because we don't know the next candle at that moment, right? We don't know because this is an H1 that needed to close. But it did close, right? And this candle has a gap, right? It should have opened up here. So this candle is actually higher than where it is right here. So this is still a rejection, and we can show you that here. Right? It's just different broker feeds. Right? It failed to surpass the level, so we know that we're going higher after that. Then we have the same thing. This open close level was succeeded by this close. So the origin point of that is here. We get the pullback. Same thing here. This broke the previous open close level over here. So yes, we do get the pullback and rejection to understand the next candle's bias. Same thing here. We have one here. But we also must check the higher time frame, right? To understand the actual move. To get a clearer picture of the market. Because we couldn't see this level on H1, which is also an open close level. It's pretty amazing, right?
Yep.
So like I said, the same thing on the bias is for all time frames. And that means for the individual time frame. So the monthly is going to tell you what's going to happen on the next month. For example, this is an open close level, and we rejected it. So we understood the next month was going to go bullish. If we close, because there's still a few days left in the month, right? So there's just one day, yeah. So most likely, if we close below this, we should have a selling month next month, or we should be on selling for next month. For example, this same level was surpassed by this level, right?
Yep.
So that's a breakout. So we have to understand, because we're expecting the next month to go bullish, but it didn't. The whole month dropped. But we also have to understand, why did it drop? Because it was a pullback. So we shouldn't be scared of the drop, and we can still participate in this market. We can still catch the drops. It doesn't mean that just because the monthly is saying to buy, that we should immediately be on buying. It's a sign for the continuation. So yeah, we have the breakout here that started from here. The monthly, the next month closed above, which is the sign for the next month to continue higher. How did we know that the drop was going to happen? Well, we can look at the weekly and we see, oh, this week we rejected it, but I understand that the monthly just had a breakout, but the weekly is against the bias. The weekly is against the monthly bias. So yeah, I can still catch the weekly. And the next candle, the next week's candle, yes, you get a big drop. Around 800 pips. This is the reason for the rally, was the trend line here, plus the monthly. Okay, so we can always frame the trade. We can always frame the trade from the monthly closing to the weekly closing to the daily closing, and we can try to align with it, which I'll show you in a minute how we align with it. But we just have to understand that not everything can be done on just one time frame. You can stick on one time frame for a while, but you also need to switch in between time frames, otherwise you might get a bit confused of what's really going on.
All right.
Hold on one second, I need to grab some water. Okay, I'm back.
All right.
Yeah, the same thing here. We understood, we had the rejection, so we understand the next day. Because if we really think about this, right, we had this huge 400 pip drop from the top, right, all the way down about 390 pips, 97 pips. So about 400 pip drop. And you would think, based on all the other concepts, you have a breakout, or even off the wick, you have a breakout, here, a double breakout. But the price didn't, it didn't continue dropping after, right? So yeah, like how would have anybody known, right? How would you have known that there was going to be a pullback? There is no SNR here, right? There is no order block. There is nothing there. How about this one over here? This push. There's nothing to the left other than open and close. So now you can start to see why I don't use SNR anymore, and I only use open and close. For this level, we also have the H4 open and close. And we also have the trend line. We could see on that daily level that H4 couldn't continue twice. So yeah, it was going to go higher. And the rejection was from here. And that's why the next candle was bearish. Nothing to do with SNR. This was also the weekly. We rejected the week, so we understood the next week we should be on selling. Same thing with the daily. We understood on the daily time frame that the price couldn't continue. So how do we line up the time frames to be in search of the big moves? Right? It's a good question to ask. Like, how do we get the time frames in order and in sync? So we have to use the same concepts that we use on the lower time frames. We have to use them on the higher time frames. So again, the only time frames we use so these time frames are your main directional time frames. With the monthly being the biggest influence. Okay, so H4 is typically the time frame that we'll be using for intraday to control our trades and for entry. H1 will be for entry, but most of the time for news. Monthly, weekly, and daily are our main directional time frames, meaning they're the bigger time frames, so they can influence price a lot. But also these lower time frames can shape the daily candle, so it works both ways. So if the H4 is telling us what can happen on H4, then H4 is going to be our controlling time frame on the daily. Daily will be our controlling time frame for weekly, and weekly will be the controlling time frame for monthly. And what I mean by control is where we're watching the close. So if I'm in a H4 entry at a certain key level, I need to make sure that the daily closes properly below a level, or if it rejects, then I know to get out of the trade. For example, if I catch this trade, which I did, and I understand that the previous day rejected, so I should be on selling the next day, and I catch the trade, I need to watch where the daily closes. But I'm not entering off the daily, I'm entering off the H4 level. So I must control the trade on H4 to make sure until the daily closes, until I get the closing price on the daily. So what does that mean by control? So if I enter off the H4, I should observe my H4 areas or key levels. I have no sign on H4 of any rejections. So yeah, I can continue holding the trade until I finally get my rejection. And once I get my rejection, I can see how the daily closed. Oh, the daily closed above. I should probably get out of the trade, or maybe I can hold for the pullback. But now I got to watch on this H4 where it ends up, and then see how the daily closes. If the daily wants to close above the level to signal a further continuation, then yeah, I'm going to get out of the trade and not try to swing trade it. What time zone are you in?
Singapore.
Singapore.
Yes.
So then you should have pretty good timing for the market, right? Market opens 6 a.m.
Um, 5 a.m. Yep.
Okay. So you should always be paying attention or having an alarm set 10 to 15 minutes before every H4 close. It'll be a lot easier for you based on your timing, your time zone to swing trade, because you have London session, I think around 7 a.m. or 8 a.m., right?
London session around 3, then US around 8 p.m.
Oh, p.m. at night.
Yep.
And then 3 p.m. for London. And then you have the 8th
Yes.
session before. Yeah. So you should be able to swing trade because you're able to monitor the whole price during the day, versus if you're from the US, you're going to be asleep during the London and Asian session most of the time. So that's why the best traders, most of them come from either Malaysia or Singapore. They have very good timing. So yeah, every H4 you should be monitoring the close. You know, that way you know where the bias is going to be for the next H4 candle.
All right.
Okay. Let's see, what's the next topic? Okay, so for example, I'm sure you've heard of the term stop punts from SMC, right?
Yep.
So we see the stop punt here. We also see the stop punt here. So the question is, how to avoid getting trapped. How do we avoid getting trapped, right? Because this could be 40 pips difference from you taking the entry just because of the daily or taking the right entry at the right place. So the first signal that you must keep in your mind is that after the price has confirmed that it cannot go any higher, any price movement going higher after that is a stop hunt. Right? Because we already confirmed, we already have proven that when the price can't continue past the key level, then the next day is going to be on selling. So any price movement higher after that is just going to be your stop hunt. That makes sense?
Yes.
Just like how we had here. The price failed to go lower, so any move lower than this is just your stop hunt. Or we can call it last price. Your last price after the big drop. So we know, oh, we're going to do the last price. We're going to have the drop afterwards. Same thing works on weekly, same thing on monthly, same thing on H4. It's all the same. Now, if we know, or how do we know that there is going to be a stop hunt, right? How do we know ahead of time that the price might actually continue higher? In this case, we must check the H4 since this was coming from the daily. And here is your first signal. We break the open and close, we close above it. That is telling you that there is going to be another push higher. So we can find the area that the stop hunt will be at, where the end of the price is. We can add the confluence. So we have a lot of confluence here. Now there's two types of entries that you can do, which is the impulse entry where you would just enter right away because we know already that it's confirmed from the previous day that the price is going lower. And then we also are seeing the breakout here saying that the price is actually going to go higher to perform the stop hunt, right? So here we're performing the stop hunt. We can then, once we get to the H4, we can drop down to H1 and we can add more confluence if we need. And we could say, oh, the price failed to surpass the trend line. So yeah, we can just enter on the next candle for the drop. We can also pair the same thing, which we have multiple views, multiple confluences from multiple different time frames, saying that this is going to be the last price before the big drop. This is where you want to add all your positions. Because you have synchrony in the time frames. Okay, so let's say, for example, and I'm just going to draw this out here. So let's say we're in a weekly time frame, and we understand that in the weekly time frame, there is 5 daily candles, right? This is daily. This is daily, daily. And we're looking at one weekly candle. And let's just say that the previous week's candle was a rejection off of a weekly level. Right, so this is one weekly candle. So that means that the next week should be for selling. But then let's say that the first day of the week was on buying. And then let's say the second day of the week was on buying again. And then the third day of the week, let's just say, was also on buying. So each one of these days is just a pullback on the weekly time frame. And let's say the fourth day is on selling. This should be when you get the idea. Because now you're synchronizing with the previous week's candle. So now we're in alignment with this candle to have the drop. Okay, and these two could be for the stop punt, or these three could be for the stop punt, for the real move. So let's say the first day is bullish, second day is bullish, and then the third day is bullish, but then gives us, let's say, on the fourth day, a rejection of a daily key level. Then we understand that the next day we should be on selling for the big move. Maybe this might be NFP or some type of news event to give us that big price movement. So they get everybody in the market on one side, but we already understand what side of the market to be on from the previous week. And that way we're able to synchronize with the previous bias once the daily turns bearish, right? But we can still follow the price action on these days. If the daily is showing signs of a rejection towards the low end of a daily key level, then we understand the same thing, that the next day is going to be bullish. So we should stick to buying for the next day until we get the sign for selling. Does that make sense?
Yes, it makes sense.
So this is how we do multiple time frame, and it's the same thing for the daily candle, except in the daily candle, we have 6 H4 candles. Right? And it doesn't have to be in any particular order. It could be the first hour of the daily is, or the first 4 hours is bearish, and then the second hour is bearish, and then the third is bullish, and then this one is bullish as well, and then we can switch back to selling. And this is how you would play intraday, by following the H4 bias in the same way you would have followed this. And then it's just understanding how to synchronize all of it, right? So, for example, using this weekly example, how we knew to be on selling for the week, but on daily we're buying in the beginning of the week. So we could just say, oh, on the next day I should be on buying. Let me look for the H4 levels to buy from, right? So then I'm buying on the H4. The third day, I'm still buying on the H4 until the next day, daily shows me a sign of a rejection somewhere. Then I can start selling the H4 to align with the weekly bias and the daily bias. Right? So it all works together in synchrony.
Okay.
Now let's take a look at another type of example. Let's say we have a trend line. And we identify that this trend line is from H4. And we understand that at this point of the market, that there is a key level. We can identify, oh, there's a key level here that I might possibly want to take the buy continuation from. But then you might get a little bit confused because down here, let's say there is a trend line key level. Now the question is, how do I identify whether or not to take the buy from here or from here, right? Because the price could simply come lower, or it could respect this and I might miss the move. Or if I take the buy here and then it does drop here, then I may be in 30 to 40 pips of drawdown, and I don't want to be in that much drawdown, right?
So I'm guessing you're gonna use the H1.
Yep, exactly. So let's take a look. We'll come back to this example, but let's take a look at the first way to handle this situation. Okay, so when we draw trend lines, which we'll cover in the next part, but we should always use 2 points, point 1, point 2. Right, it's point 1 and point 2. Okay, so we see how price came here, but we also have, this is an H4 chart, and we see that there was the break of this level, and then here is our key level, right? This is the key level, and it did respect it. But how could we enter that? How could we know without the closing price to know that this is the level to buy from or this is the level to buy from? So during this candle, the H4 hadn't closed yet, right? There was still about 2 hours left, I believe, in this candle before the H4 was going to close. And this was also during news. And for news, we use H1. So during H1, we saw that the candle was dropping, but the H1 had not closed yet, right? So of course, I'm not going to buy here because the H1 had not closed, right? So I avoid buying here because I didn't get my closing price yet. But then once H1 closed at the trend line and closed above, yeah, I can take the entry on the next candle because there is no continuation, right? The price stopped and you just enter on the opening price. So that's one way to avoid it. Going back to our main example, we can do the same thing here, is just wait to see if the H4 closes above, or if there's still time left, we can wait to see if the H4 will close here. So that's just one way. The second way is if we look at this, and let's say we have a wick above, and then a wick here, indicating that the next price movement should be higher, right? Because this is a key level and we rejected it. But what if something like this happens? And you get scared out of the trade because let's say this is, 100 pips of drawdown or 50 pips of drawdown, whatever. And you don't want to take that type of drawdown. So we need to predict the stop hunt, right? Because this is the stop hunt, but this is the confirmation. At the key level, if the price rejects it, then we should understand that the bias is actually on buying, right? The bias is on buying. So if the price drops like this, we need to be alert and aware that we do have a trend line below that it could possibly go to, or maybe there's another key level below that it can reject. So let's say that this candle hasn't happened yet, and we want to know if there is going, in fact, to be another stop hunt. We have to zoom into this candle on H1. So let's just say the first H1 candle looks something like this. And then the second H1 candle looks like this because this is H4, correct? But then the third H4 candle looks like this. And then the fourth one looks like this. Let's just move this slightly up like that. Okay, so that should form this type of candle. Something like that, right? This is the rejection. This is the wick up here. The top wick would be these two bullish candles. So the price ends up looking like this on H4. And then when we zoom in, we see that, okay, so H1 actually has a sign of a breakout to continue lower. I don't think I'm going to take a buy from here just yet, right? I want to wait to see what happens at this level. So let's say on the new H4, that's going to come after this, we get this sort of thing. And the price rejects the level, right? The price rejects. So we understand that the bias on the next H1 should be on selling. So this would be the second hour in the new H4. Okay, it's dropping. And then let's say it closes at the trend line. Well, that tells me that now the H1 is on a bullish bias to go higher. But let's say on this new H1, the price breaks out from here, right? Now we have a clear indication after taking our buy here, we enter the next candle, and then now we see the breakout for the continuation move higher. And then finally, the H4 closes above and creates that green candle. So it would look something like that. Right? Because at this point here, H4, right? Because the H4 bias is bullish, and now we have the H1 aligning with the H4 bias by the rejection at the key level. So that's how we can understand, oh, there might be a stop punt because we do have a breakout from the H1 inside this H4 candle. Even though we have the rejection, which is a bullish sign, we should still be paying attention to if there's going to be another drop or not.
Okay.
It's a little confusing, but hopefully that makes some sense.
Yep, it makes sense to me. Yep.
Okay. So this is how we solve getting stopped out or anticipating the stop hunt, right? We're using the multiple timeframes together with the key levels and our higher time frame bias, right? Which our higher time frame is the H4 in this scenario. So the same thing applies to it on the daily, you know. How we showed this example here of the continuation move higher to avoid taking the sell from just the daily level. The same thing can be said about the weekly. We did have a rejection of this level, but then the price went higher to do the stop hunt. And how did we know that that was going to happen? It's because once the price rejected and moved down on the weekly time frame, we had a rejection on the daily, giving us the signal that the daily wants to do the stop hunt now. That way we don't get mixed up with the higher time frame and lower time frame. We understand the purpose of why the price is moving higher, even after we get a rejection on the higher time frame. If we see that the weekly got a rejection for a bullish move, but then the daily's showing us a rejection for a bearish move, then we understand that the daily is signaling that it wants to do the stop hunt. And all we're doing is stacking confluences in our favor to strengthen our moves. Right, we have the rejection. Now you might be thinking, well, we do have the rejection here, right? But how do we know not to just enter on the next candle? Because this could be quite a bit of drawdown, right? About 50 pips of drawdown. Well, this broke. So we understand, even though it closed above, that there is going to be another drop. So if we understand that there's going to be another drop, I need to be buying at the next key level to reduce my SL. So now instead of 50, it's 30. So I cut my, or it's 28. So I cut my SL by 20. And if we want, we can shrink it even more. But this is during news, so you should be using a wider stop loss during news. On this one, the difference is this wasn't news, this was the news. Right? So we could get in early before the news. Okay, let me see what's the next part of our lesson. Okay, so let's cover the trend lines. One second, let me grab some water real quick. Okay, so let's dive into trend line and how we need to observe trend line. So we have, the traditional type of trend line, which is just 0.1, 0.2, 0.3. And then we have the opposing side of that, which is 0.1, 0.2, 0.3. So we have the upward trend line, and then we have the downward trend line. But we also have the upwards divergent trend line. And then we also have the downwards trend line for divergence for the bullish. Okay, and then we have the type of trend line where it's the breakout type of trend line, which is 0.1, 0.2, and then 0.3. And then we also have the bearish breakout trend line, something like this. And then we also have the QM trend line, which is just 0.1, 0.2, and then also 0.3, which we could just use this. Okay, the whole thing with trend lines is finding 2 points of the closing price. What we can use is just the line chart to find those closing prices, right? It's 0.1, 0.2. Same thing as here. So this is the daily trend line. We have 0.1, 0.2. Same thing. We have 0.1 and 0.2. Okay, as long as there's just 2 points, that's all that matters. Because we pair this up with the key levels. And this is going to be one of the hardest things to get used to, is drawing the trend lines, because there is it takes quite a bit of your eye being trained to see it. So if we just go through these examples, this is point 1, point 2, and then point 3, and then with the confluence. Point 1, point 2, point 3. Point 1, point 2, point 3. We have our confluence here. Point 3, right? Because this is the same thing. Point 1, point 2, point 3. And we control this, right? This is the one where we entered on H1, but we need to make sure, because we're entering on H1, that we remain above our key level. So as long as we remain above, we close above, it's safe to hold. And once you get better at it, you'll be able to just see the confluences fairly easily. You can also use this on daily. Daily, weekly, H4, it doesn't matter. We look at weekly. We already discussed this one. And remember that trend lines also act as key levels. So if a trend line is rejected, it's treated as a key level.
Okay.
Broker feed. This actually hits on my broker. And again, the trend line is just one view, right? It doesn't mean that you should only take trade because of trend line. It needs to have the confluence. So each thing is perspective. You have your OHLC perspective, you have your multiple time frame perspective, and then you have your trend line perspective to give you a clearer picture of the market. This one is for this one. It's just the magnet won't let me. Yep, this one was from here. Let's take a look at this price action. So yeah, this we can pair with daily around this level. This is 0.1. This is 0.2, and this is 0.3 for the drop. This is 0.1, 0.2, 0.3 for this pullback. Point 0.1, 0.2 for this rally. We also have a confluence here. We do have an open level exceeded by this. It's a little bit higher, but I believe this is a daily level. Doesn't work. Okay, so with trend line as well, I have to mention this. Let's say we have a trend line going downward, and then a trend line going upwards. So we do have one trend line here. And then one trend line below. And let's say price is right here. So which trend line do we choose, right? It could be this one or it could be this one. So the rule of thumb is whatever trend line comes first. So if this trend line comes first, we must pay attention to, first of all, what time it is so that we understand when the closing price is. Let's say the closing price is in an hour, then we want to make sure that the H4 closes above this trend line. But let's say it's on the first hour of the new H4, then we want to wait and see if the H1 is going to reject here or if it's going to reject here. So we need to get some sort of closing price in order to tell us which trend line is it actually going to be. Because price could just melt through this until we wait for the closing price. If we get the closing price on the second trend line, then yeah, we can take a possible buy there. Right, this is 0.1, 0.2, 0.3. This should hit here. You have to check the broker feed on that one. Does the trend line make sense?
Yes.
Let's cover the next topic. Okay, so with trend line, you also want to be doing the trend line in the direction of the bias. So for example, once the daily bias was confirmed on this candle and we understood that the next day we should be looking for buys, we should be looking at trend lines that point into a buying direction. 0.1, 0.2, we should be looking to buy on the trend line. 0.1, 0.2, we should be looking to buy on this trend line because this was a buying day. On sell days, when the bias changed on this candle, right, because this was the next day's candle, we should be doing a selling trend line to align with the bias. A problem that a lot of traders have is they'll draw every single trend line for every single direction. If I did that on a non-buying day and it was on a selling day like this one, and I ended up doing a buying trend line like this perfect one here, I could get stopped out, right? Unless I understand that this is just the pullback, right? 0.1, 0.2, and then this is 0.3. It's a perfectly clear trend line, but we understood that on this particular day, the bias had changed to selling. So on the selling bias, I don't want to be drawing buying type trend lines. I'll have more success with selling type trend lines. Another mistake is, for example, what traders do is they look to the left, which is fine, but they'll mark out every single key level. And this is too many, right? This is too many key levels, first of all. Second of all, you're avoiding the trend trying to catch the reversal. When we get the indication that we should be on buying from the daily bias, we should be looking for the key levels of buying. right? We need to be going with the flow of the market in the current state, not trying to find the reversal, right? So most traders during this rally, this drop, I mean, they're looking for all the buy levels on this side, and they're just getting smoked, right? Just constantly stopped out because they're not trending with the market. At these points, we should be looking for selling. On this side, everybody else is switching back to selling because, oh, I guess it's now time to sell it. And then they get stopped out again, right? Because they're not buying when they should be buying, and they're not selling when they should be selling. You have to be in sync with the market and understanding that bias and lining up your confluences with the bias. Does that make sense?
Yep.
Okay, let's talk about the next topic. So far we've covered the AOHLC system. We've covered multiple time frame, the directional bias. We've covered trend line. Covered confluence. Mixing. Now we need to talk about risk management. Oh, and we've talked about going with. Now we need to talk about risk. Are you clear about how I enter trades?
Yes.
Okay.
On the 4H and 1H with key levels and trend lines.
Mm-hmm. It's always on the next opening candle, right? So, for example, if this one rejects, I just enter the next candle.
Okay.
Yeah, stop below.
So it's just market execution.
Right. It's always market execution.
Okay.
So as far as risk management, have you practiced risk management before?
I have a big, I risk around like 5% per trade
Okay.
or something like that. Yeah.
So if you're doing a funded account, it was 1 to 2%. And if I do a live cash account, it's 5 to 10%. So 1 to 2%, what does that mean? 1% and sometimes less for playing pullback, and then 2% for main direction. And the same thing applies to here. 5% for pullback and 10% for main direction. Because we need to understand what the pullback is, right? So if, for example, on, let's say on this level here, let me use this broker. On this level here, I understand that we have a breakout, right, of the open and close level. We broke out. So any drop is just a pullback. So I'm labeling the type of movement that it is, right? So I know I can risk 5% on a live cash account of the pullback, or 1% or less on a funded account on the pullback type of trade. But on the main direction, like this one, then I'm going to risk 10% or 2% depending on the account. That way, the pullbacks, because they're most likely going to just be a pullback, right? It's not going to be that much from a breakout. So yeah, I'll risk a smaller amount on those type of plays versus the main direction type of play. And then as far as holding the trade, I'm just observing the continuations, right? This level had broken this level over here. So this is a breakout, right? This is a breakout of this level. And then we have a rejection here. So in order for this to continue lower from this level, in order for it to drop further, the price would need to close below this level to signal the reversal. So yeah, I could just hold my trade once I get my daily closing price here. I could still hold the trade from way back here, as I'm paying attention to the price at the important closing levels. So for example, let's say I come to the trading day and I want to maybe possibly take a sell at some daily level over here. Right? If I wanted to take a sell from that level, I would try to find my areas that I would possibly want to sell from. Once I get my closing price, like as a rejection of this level. In case there is the stop punt, I want to be able to understand where the price could perform the stop punt, right? So let's just say we have 1, 2, 3, 4 areas of possible trades. Right, so I know that here I have possible trading areas that the price could do what I want it to do, which is come up and then reject, to give me the sign that we're going to go bearish, right? It's my first indication. So that can happen here or here. Now, let's say the price doesn't do that. It doesn't come, this one, it just surpassed it and it closes above. So then I know there's going to be a continuation. So out of the 4 trades, there's 3 levels left. And let's say on a 1 lot, we're risking per trade. And my SL is typically 20 pips. And since we're on H4, I might only go for 50 pip TP. If it was H4 that's in sync with the daily, then I might go for 100 pip TP. And then if it's a daily with the H4 with the weekly, I might go for a 200 pip TP for the larger moves. So it all depends on where these areas are and what timeframes they're rejecting. But let's just say, for example, we're risking 20 pips with the SL on a 1 lot. So that's $200, right, per trade. And we have 1 out of the 4 levels is invalid because of the closing price. So now I have 3 left. If I lose 2 of the 3, I lose 400, right? And if I win 1, I win 500. So I end up positive 100. Let's say that that doesn't happen, and then this level just closes above, and I don't get the sign. Well, then now only 2 out of the 4 are valid, it's invalid, and I only have 2 areas left. And then let's say, for example, this one rejects, but then maybe we missed something on the H1 where it was signaling this was going to go higher. and I take the loss. So now I only have one area left, right? Let's say it's this last area. And then I finally get my entry, right? It's the one trade that won. So two of them were invalid because they didn't do what we needed it. And then the last one was valid, but then we maybe missed something, so we took a loss. So that's minus 200. And then finally, we get the one that gives us that 50 pips, and we make the 500. So now we're positive 300. But let's say we don't see any sign of a reversal, and H4 has time to close. And H4 just keeps dropping, and we get 100 pips. So now we're up 1,000 minus the 200. We're positive 800 for the day. So this is how I manage my trades. I understand what levels I'm looking to trade at once they follow the system of the rejection, and I see that it's at a level, let's say on a daily level, that we can see there's some sort of rejection area that we can get in on, or if this is going to perform the stop hunt, then yeah, I can take the trade and still be positive and avoid all the bad ones. And if I take a loss, I may have seen something that wasn't there, or maybe I had just made a mistake in my calculation, whatever the case is. The fact is, I'm just looking at the areas of potential trades, right? Marking them out. Oh, okay, we have 5 trades today, 5 possible levels. Let's say we had 10 possible levels. I may shrink my risk for that day. Instead of a one line, maybe I might do 0.5 for each. Or maybe instead of, if there's only 2 or 3 areas, then maybe I might increase my risk to maybe 1.5, 2 lots for the day, right? Because for example, on this day, when we had the drop, there was only this opportunity to get in. There was no other opportunities because this is the H4 candle after. So if you were planning to take buys, all your buy levels were invalidated, right? As the price was coming down, all of them didn't follow any of the rules. So there was nothing. The only last one you had was coming from the daily. So this would be the only buy level you had on that day. And it would have been at the market close for the next day. So yeah, you avoid the bad situations. And if you caught this, you're able to hold the trade for 400 pips, around 400 pips, because the H4 was telling you not to get out of the trade until down here. Does that make sense? Okay, so do you have any questions so far?
Mm.
I'm sorry?
For now, no. Yep, everything's quite clear.
Quite clear. Okay.
Mm.
Because that's pretty much the whole thing. That's my whole system. We went over OHLC, multiple time frame, trend line, bias, risk management. The market flow, entry, confluence. And we have about an hour left. There's not much else to teach other than this, just going over the same things. So what I can do, yeah, so what
I
I
do
can do
thought
is,
of a question.
sure.
Could you combine, let's say, a 4H trend line with a daily key level?
Yeah, you can combine both trend lines, right? So the same thing that we had here, we also had the daily trend line coming from here.
Okay.
Yeah, it's even a stronger confluence, but we have to do it in the direction of the bias, right? Because the bias was on selling from this previous day to tell us that the next day was going to be on selling.
Okay.
So yeah, once the price was going higher when we were monitoring it, we could see, oh yeah, if we drop down, we can see that H4 rejected the price, right?
Yep.
So once H4 rejected the price, any move higher after H4 rejected is where I'm taking my entry. So I'm just stacking the confluence, and then I'm seeing, okay, H1 rejected as well. I'll just take the entry on the next candle.
Okay.
Yeah. So since we do have an hour left, what I'm gonna do for you is because we went through the lessons pretty good because you were just listening most of it. So you have 1 hour to schedule in the future if you have more questions.
All right.
So yeah, just let me know in the future. Just I'm gonna send you my Telegram so that I can send you the recording of the lesson, and just let me know if you need another lesson, and we can schedule that extra hour in.
Okay, cool.
Cool. I'm gonna send you my Telegram username on Instagram, and then just message me from there so I can send you the video.
Okay.
All right. I hope this helped you a lot, and it would change your perspective a bit on the markets. Yeah, if you have questions in the future, just let me know.
All right. Thanks, Evan.
No worries. Have a good one.